Common wisdom suggests an investment portfolio should be diversified, a variety of assets with different levels of performance and risk. But beyond that, what does a well-balanced portfolio really look like? Amanda Lang spoke to David Kaufman, CEO of Westcourt Capital, recently, and asked him what makes up a really well-diversified portfolio.
We need to understand that diversification really has two elements to it. The first is that you'd like to be diversified among different, say, managers or asset classes or strategies to make sure that you don't, put the proverbial all your eggs in one basket, so that if something isn't working, that you're not going to suffer. The other is that, let's say you have an equity manager, that within that fund, that there be enough diversification so that that manager is not taking all of their risk on, say, Apple or something like that, because anything can happen. And what we find when we look at portfolios, when we first meet a client, is that typically they are under-diversified among asset classes and strategies and way over-diversified among securities, meaning that they might only have 2 or 3 different managers in their entire mix, but then they'll have hundreds of different equities. And we find that to be sort of the inverse of how they really should be looking at it.
So in terms of figuring out how diversified you should be across asset classes or strategies, whether that's from a manager or the type of fund or whatever it is, how many is the right number? How do you decide on that?
Well, the first thing is to make sure that you're not diversifying in name only. So, we see people that say, I've got a bucket for large cap equities and a bucket for small cap equities. And it's true that at most of the time they don't react exactly the same, but they're both equities and they both kind of will go up and down along with the markets, or Canadian and American, European, EFI, that sort of thing. It's important to understand that you have, that equities is like one big bucket, and that you have fixed income, which is another bucket, but it too has different types of diversification available within it. The point is this: you'd like to make sure that if some macro event happens, and Russia's in the Ukraine, that not everything that you own is being affected the same way at the same time, because that's like dropping the basket that has all the eggs in it.
When you talked about the number of investments people have, do you have an insight about why we do that? Why do we have so many little investments rather than actually thinking about what the right size of an investment should be?
Sure. When someone they hear about a prospective investment, they think, well, I'll just put a little bit in there, I'll dip my toe in the water, how bad can it be? And it's true that if you just want to play the dip your toe in the water game, you can start with a very small allocation. The issue is this, that there's only so many good ideas in the world, and so that if you end up having 40 or 50 different investment funds, say, in a portfolio, unless it's a massively large portfolio where you have capacity issues, but let's keep it to normal people here. What you're doing is you're diversifying towards the mean. In other words, you're very likely to get average results when you have so many constituent elements that you basically are average. So what you would want to do instead is try and find the best of the best. Don't try to be average, try and be above average. And the only way, by definition, to be above average is to hold fewer actual holdings, and then try very hard to identify, for example, the managers that are absolutely best in class.
I've heard some people say, you should never have any single name be more than 10% or 5%. People differ on what that percentage is of your total portfolio. Mm-hmm. Do you have a view of what the right size for individual investments are relative to the overall base? We
try and help coach a client to kind of find that number for themselves. So we look at 3 things. Number one, the number in dollars that's allocated to a certain strategy has to be small enough so that you're not losing sleep at night just because the number is so high, no matter how much money you have. The second is that you want to make sure that you have a big enough allocation to move the needle. I'll tell you why. If you have positive performance and it's too small, it doesn't really help very much. But if you have a small investment and it loses 20 or 30%, that's going to keep you up at night, and it never had a chance to help your whole portfolio in the first place. So that's asymmetry going the wrong way. The third one, which is very important, especially if you have any real risk in an investment, is that you'd like to cap the size of the investment so that it's small enough that a total loss would not, irrevocably impair your ability to live the rest of your life the way you wanted to live it. So when you put all of that together, usually one would think that around 20 different investments, i.e. representing about 5% of your portfolio, would have a check mark in all 3 categories. But we see a lot of the most successful investors having as few as 10 or 12 different investments. Yeah. And when I say that, they are themselves diversified. They're not putting 10% of all of their money into Apple. They're putting 10% into an equity manager or something along those lines. So somewhere between 10 and 20 makes sense, but then we get back to the idea that you're going to run out of good ideas if you try and get to 30 or 40 or 50.
You mentioned this notion of preserving capital, having some investments that way, if all else fails, these ones will be fine. that's sort of the low risk investments. Do you have a sense of what percentage of your capital should be in that?
It depends on one very large question, which is your ability to earn it back.
Right.
So if someone is earning a lot of money and they have very little chance of ever losing their job, then they can take a little bit more risk because they're in that happy position that if the sky falls, that they can start again. But if you've inherited money, or if you've worked your whole life and retired, you have it one time only, then you have to do everything you can to protect it. That might mean that you have to live, a less luxurious lifestyle than you might otherwise, because you want to make sure that you can at least continue to live that lifestyle, infinitely.
I'll leave it there. Thanks, David.
Thank you.